Hey guys, Venk Ramkumar again. We're here to do some more investment analysis. Thanks for joining me today. I really look forward to giving you guys an update on my portfolio investments and hope that we can learn together. I'm going to be trying to show you guys what I know and what I believe is going to be a good investment going forward. And we're going to do the analysis on it. So let me pull up my presentation, guys. Thank you for joining me again today. Quick update, I've been on vacation for 3 weeks, so I just got back a few weeks ago. So I haven't been able to upload much, but now we're back in full swing. We're in full gear, high gear now, and we're getting ready to tackle the markets. I was still watching the markets, I just wasn't making videos. All right, guys, once again, like I said, investment analysis. My name is Venk Ramkumar, Venkatesh Ramkumar, or Venkatesh Ramkumar. But you can call me Venk. So, guys, quick update on my portfolio, right? Like I always do. The blue is my portfolio. Since I've already given like a 2-year, 3-year performance versus the S&P 500 in my past videos. So if you haven't seen it, go ahead and go back. From now onwards in every video, I'm just going to go back 1 year and show you guys how I'm performing. Since you can go back and basically if you put it all together, you can see how I've done from the start. But yeah, I mean, I continue to outperform. Obviously on really big up months, like for July, obviously I didn't really have a huge up month, but I'm not really a typical growth investor. I invest for value and income, but also for cheap companies that are good companies. So a lot of times I don't actually perform like the S&P does, which is a good thing because when the S&P goes up, a lot of times I do go up as well in value, a lot of my companies, but a lot of times when the S&P tanks, a lot of my value stocks retain their value or actually grow. As you can see from December till the summer. So there's a quick update, guys. So before I get into the company that I'm going to be talking about, I want to first talk about something that's been on my mind that I see a lot of people doing. And I know you see a few of these bullet points here, but I want you to hear me out and see my perspective on this. It's not just my perspective. I know many things are facts here too, but I'm just giving you my perspective on these facts. Basically, a lot of the people nowadays are trying to put politics into their investing, whether they like a company or they don't, or they like a political party or they don't, or they like a certain cause or they don't like a certain cause, and they're investing based on that. Now, what does that, people will tell you that, oh, when you invest in a company, you're actually helping the company grow. But is that actually true? What does investing actually do for a company? Well, in order to know that, you have to understand how investment banking works and how companies raise money and actually go public. You see, when a company goes public or when it raises money, usually what it does, like for example, if a company wants to go public, what they're doing is, let's say for example, solar energy company, they want to go public. Well, they'll go to investment bank for funding, and the investment bank will give them a certain amount of funding based on their analysis of valuation. And then the investment bank will in turn take a certain ownership of that company, and the investment bank will now be able to sell shares of that company into the market. So when you're buying into a company just based off of politics or what you think they're doing, you might think you're helping the company, but in reality, the company's already secured the funding for its shares. So it doesn't matter whether you're investing in a tobacco stock or defense stock or a solar energy stock or a stock that helps animals. Really, when you invest in a company, you should be investing to make profits, because a lot of times the company doesn't really care if you buy their stock or not, because the company's already got the money. They've already got the funding for their business. So that's something to keep in mind. I see a lot of people in Gen Z and even millennials getting, and I think, suckered in because they're buying into companies that are on either side of the political spectrum, or whether it's a certain political party or certain green energy, or whether it's for the Republican Party, some stock or whatever. It doesn't really help the company if you really understand how investing works. Your really investment is really you putting in money or capital in terms of stock market, you putting up investing time, you could do time, money, capital in order for you to get a gain back. Okay, so that's truly what investing is. So guys, the company that I am going to analyze today is Merck and Company. Obviously, as you guys know, Merck and Company is a part of the pharmaceuticals, right? It's part of Big Pharma. And this is once again what relates to what I was talking about. A lot of people like to say, oh, Big Pharma is this, bad, good, on both sides of the spectrum, right, left, center, they say, but at the end of the day, you're investing because Merck does make some great products that help a lot of cancer patients in many ailments. And whether you agree with them or not, a lot of people do use their services and products. And this is a company that you have to analyze from a cash flowing business. Because, for example, so people are not going to buy their drug if it's not helping them, right? They're not going to buy a drug or whatever if it's not actually helping their ailment. So you have to analyze the company in terms of a business. Usually the free market can decide whether a pharmaceutical company can be profitable or not, because the free market is going to base it off of how do those drugs actually function, right? So if we look at Merck here now, I'm going just based off of the financials now, and I'm going to first start off with fast graphs, which you guys may know. I'm going to explain this, and then I'm going to go into my own analysis, and I'm going to break down these numbers and how you get them. So if you look at Merck, here's a 20-year history of Merck stock, more like 25 years. And right here, the light green is actually forecast, analyst forecasts. This blue line right here is a PE of 15, which is where the S&P is traded. Now, if you don't know what PE is, go back into my last few videos, but PE is basically a valuation metric because it's basically price over earnings. For example, the price of a share over the earnings per share. So you're basically getting a valuation of how many years is it going to take to regain your initial investment. So for example, if a company is worth $1 million and it makes $100,000 a year in earnings, that's a PE ratio of a million over 100,000, which is 10. So for example, the company might break it into their company into 1 million shares, right? So each share is $1. So it would be, like the earnings would be 10 cents per share. So it'd be $1 over 10 cents. It's a PE of 10. So right here, as you can see, these are the earnings for Merck over the last 20 years or so. They earned 256 at the end of December. So Merck makes it easy because they have their fiscal year at the end of December. So as you can see here, December 2002, December 2003, December 2004. So after this is January 1st, right here. So $2.56 per share. So if you took $2.56 per share and multiplied that by 15, you would get a 15 PE ratio right here. Okay. The funny thing about Merck is that this is the 14.97, 14.97% PE ratio is very close to where Merck is actually traded on average. So if you took the average of where it's traded, that's why you can't actually see the orange and blue, because the blue is representing 15 PE ratio of the S&P 500, and the orange is representing the average of where Merck has traded, right? So you can't really see that here because the orange and the blue are right on top of each other, which means that Merck has traded roughly around a 15 PE ratio, meaning for every year that it's done earnings, it's traded on average over the course of 20 years at 15 times earnings, okay? So for example, if you take 256, multiply that by 15, you'll get a certain price. Now, Merck did not necessarily trade there, right, that year, but over the course of its years, up and down, sometimes it's overvalued, sometimes it's undervalued, right, during 2008, it averages out to roughly a 15 PE. Okay, so you can basically say that safely, you can say that every time Merck gets under a 15 PE ratio, it's a good time to buy, right? After 2008, maybe after the dot-com crash right here, you could have made handsome profits when you buy right here, because the stock, you can't really see it here because it's black, shaded by this black here, or it's covered by this black here, but you would have made handsome profits when you buy at cheap valuations under the historical 15 PE. Now, these are the analyst expectations. So obviously, like I said, I'm not a subscriber of FastGraphs. It's a great software. If you guys, I recommend you guys subscribe to it, but I don't. So I took this off of a YouTube video that they made. So obviously this is April 2022. But what you can do is you can actually still use it because you can use the data within Fastgraphs to still paint a picture. And obviously, you have to use different sources, and you have to do your own calculations, which I'm going to show you guys. So at the end of December 2022, Merck is expected to earn $7.21 per share. At the end of December 2023, it's expected to earn $7.23 per share. And at the end of December 2024, it's expected to earn $8.32 per share. We can see right here that Merck is currently trading at a 13.67 blended PE ratio. A blended PE ratio basically takes the last 2 quarters and the forward 2 quarters, the 2 quarters in front to do it, instead of taking the last 4 quarters like the normal PE is. So it's a little different, but it's very, very close. So as you can see, Merck right now is trading cheap in relation to its historical PE. So for example, Merck is traded at an average of a 15 PE ratio for its whole last 25 years, right? Now it's trading at a 13, and its earnings are expected to grow quite strongly. They're expected to grow 20% in 2022, not much in 2023, and 15% in 2024. So that makes us think that, okay, maybe there's a good, right? If Merck just comes back to its normal 15 PE that it did, like it did back here, right? Or like after 2008, it reverted back to a 15 PE, you can, right? If earnings continue to grow for the next few years, you can make some handsome profits here, right? Even in the next 2-3 years, you can make some handsome profits. So we're gonna calculate those profits. What are the expected profits, even if Merck just returns to a 15 PE? Now keep in mind that it could overshoot and get euphoric, but usually when it gets euphoric, it falls back down to reality, right? Up right here, you see it falls back down until earnings start to grow, which is when the stock is finally started to take off. So the stock price will always follow earnings, guys. Please keep that in mind. So like I said in my last few videos, you also have to use other resources. I mean, you can't just use one resource. You can't just use Fastgraphs, and you have to also know how to do the calculations, which is why I'm going to do it for you right now, right? So let's double check here, right? December 2022 on Fastgraphs, it says Merck is expected to earn $7.21, right? And as you can see here, the blue bar is what Merck has done in reality, and this bar right here is what analysts expected Merck to do. So as you can see, Merck has been very, very close to analyst expectations. It missed 1 year, but it's beaten it all the other years. So it's a good chance it's probably gonna either beat or at least meet. December 2022, the expectations is 737, right? So that's even better than what it showed here on Fastgraphs. Now, December 2023, 723 on Fastgraphs. Now, I didn't hover above that, but you can see right here, December 2023, earnings per share 745. So that's even better than what Fastgraphs believes. December 2024, $8.32. On Seeking Alpha right here, December 2024, $8.49. So Seeking Alpha, and this is probably because this is more of a live view, because I just took these screenshots today, guys, and today is August 3rd, 2022. So it's probably because Merck has upgraded its guidance. It's probably increased its guidance, which means the company has increased its earnings expectations going forward, which is why, since this was taken back in April, right? This is because I took screenshots of the YouTube video. This is probably an updated guide to what earnings are going to be. So that's a good sign, actually. Another thing that's a good sign is, when we go back to the Fastgraphs, right? When earnings expectations were lower, right, during Fastgraphs in April, stock was trading at around 86.91, right? Right now, it's still trading at around 87.50, and sometimes it's even trading around 87. So all the calculations, this is a 1-day graph, guys. So it's not like I'm doing a 6-month graph and showing you guys where it's trading. As you can see, Merck still continues to trade around 87. So all my calculations in this PowerPoint are going to be done at a share price of 87 to keep it easy. Okay, so this could be a good opportunity, right? So let's do the calculations. I'm going to break down my calculations in terms of capital gains first, so what the actual share price could be. Then I'm going to break it down to where the dividend could grow to and what your yield on cost could be. If you don't know what yield on cost is, please refer back to my first video, I believe, which is where I break down exactly what yield on cost means. Basically, it's if you buy a share today, how much are you going to be getting in dividends in the future in relation to what you paid for it? in terms of dividend growth. So we'll get into that. So if Merck meets its 2022 earnings expectations, right, of $7.37 at the end of December 2022, it's August right now. $7.37, which is the Seeking Alpha estimate, and $7.21, which is the FastGraphs estimates. So I'm taking all these estimates and I'm going to create a model for you guys. Yahoo also has the same one. Yahoo's estimate is the same as Seeking Alpha's at $7.37. So it's very easy. All you have to do is take, so remember, PE is price over earnings, PE ratio equals 15. So like we said, all Merck has to do is revert back to its 15 PE ratio, which is traded at in the last 25 years, right? It's always, every time it's been undervalued, it's reverted back to its 15 PE ratio. It might have taken a year or two, but if you're willing to be patient, it's most probably going to revert back. So if we take price over earnings equals 15, so if you do the calculation, right? 15 equals price over earnings. So earnings, what was the earnings estimates? $7.37, and that gives us $108.15. Oh, I'm sorry, that was FastGraphs, so that was this estimate, $7.21. So if you take $7.21 multiplied by 15, you're going to get price. Okay, guys, if you don't understand this, please rewind it, because I'm trying to get through all this information. So please rewind it. I'm sure you're going to understand it. It's not that hard. Now, if we use the Seeking Alpha, which is obviously more up to date, right? $7.37, we get an even rosier picture. We get 15 times $7.37, which is at a 15 PE, a price of $110.55, which is 27% upside. And obviously Yahoo Finance is the same metrics as Seeking Alpha. So as you can see, we have quite a bit of capital gains we can make from the stock by buying it at a cheap valuation, as we see right now, right? If it reverts back to 15, it could even go to 16 or 17, like it usually overshoots, right? Obviously then it's overvalued, but I don't recommend trading in and out of it. I recommend buying it at 13 or 12 PE or whatever, and just holding it for the long term, because this is a company that's been growing, right? So obviously the 1 year forecast, or at least a few month forecast, we can see that the price is expected to go, if it reverts back and if it hits earnings, which it usually does, it's expected to go quite a bit higher. I now want to go out to January 1st, 2025. January 1st, 2025 now. I don't have any data. Oh, no, I do have data from Seeking Alpha. I do not have any data from Yahoo Finances. They don't go out. They just have not posted it out that long. But I have Seeking Alpha and I have FastGraphs. So FastGraphs is 832 and Seeking Alpha is 849. So all you have to do is utilize the same strategy that we use to calculate the share price here, price over earnings at a 15 PE, and we get at the beginning of 2025 or at the end of 2024, with the conservative FastGraphs estimates, earnings estimates, a share price of $125, which is roughly 43.4% upside, or roughly a 15% annual rate of return compounded. Now, I know you're going to be like, whoa, 15%. Well, that's even lower than 24% here. Well, yeah, but you have to realize that that's 15% compounded every single year for roughly 2.5 years, right? So 15 times another 15%, and then times another 15%, but not fully 15% because you only have about 5 months or so until December, until the new year now. So it's about 2 years and 5 months, right? Annual rate of return 15%, which is overall about 43.4%. The same calculations now using the Seeking Alpha estimates are for 2024, $8.49, right? If you do the price over earnings equals 15, right? 15 equals price over earnings. 15 equals price over $8.49. Then you multiply both sides by 8.49, you get the price of $127.35, which gives us 46% upside, or 16% annual rate of return compound, right? So compounded, that means 15% this year, and then we're going to take, so the current value right now of the share price times 1.15, and then take that new price and then times 1.15 again, right? So it's not just times 1.15. Yeah, I mean, you know what I mean. It's compounded again and again and again for 2.5 years. So that's very powerful. So as we can see, guys, what I want you guys to get from this video really is, if you don't get on anything else, it's you want to buy stocks or companies when they are cheap in relation to what their future earnings are going to be and what their historical price earnings valuation was. All right. So guys, this part might be a little confusing, but I want you to really try and stay with me here. I'm sure you guys can understand this. Okay. So right now the company is paying out an annual dividend of $2.76. And usually what happens is Merck raises its dividend. It's raised its dividend every year in December. So it usually raises it before the new year. So in December 2021, they raised their dividend to $2.76. And for the year end 2021, right, the earnings per share were $6.02. Now you can get this right here from Seeking Alpha. If you hover over this, December 2021, it was about $6.02, right? So how much of their dividend or how much of their earnings are they paying out in dividends, right? Because when a company has shareholders, it's probably going to pay if you make $100 and you're the owner of a company, you have a bunch of shareholders, you're probably going to pay them half your earnings so you can reinvest the other half, right? If you own a business, you're going to probably use some of that money to live on, then reinvest the rest. So that's kind of what's happening here. So the payout ratio is 45.84%. The payout ratio is how much is the company paying out in dividends over how much the company's earning. So it's a 45.84% payout ratio, right? Now, what we have to do here is we're going to assume that the company is going to keep the same. I moved it up to 46 just to keep it an easy number. Let's assume that if Merck hits its earnings, which, the only year it did not really hit its earnings was 2020, December, right after, COVID and all this. But even that, it barely missed it, right? So I don't think it's going to miss it by much. But, right, let's say Merck meets its earnings, it does not exceed its earnings. Well, at the end of December 2022, guys, it would hit $7.37 earnings per share, right? At a payout ratio of 46%, the same amount of percentage of its earnings that is paying out dividends now. It does the same thing. It's going to have an annual dividend of $3.39. So that's quite an increase, from this year, which is going to be good. It's going to be great for shareholders. And our yield on cost is going to jump to $3.89. So what is yield on cost? Guys, right here you can see we have a dividend yield of 3.15%, right? That's basically saying if you buy $100 worth of the stock, how much are you getting back every year in dividends? Well, let's say you buy $100 now and you're getting $3.15 back. I know the share price is $87.56, so it's not really 100, but I'm going to try to keep it easy for you guys. Let's say the share price was 100. You'd be getting back $3.15 every year in dividends, right? So if it's a payout ratio of 46, it's probably earning like, I don't know, $6.50, right? Because it's paying out 46% of its earnings. Well, you put in $100 into the stock, but let's say it raises its dividend next year. Well, now how much are you getting back on your initial investment, right? Let's say it raises the dividend to $3.39, let's say. Well, now your yield on cost would be 3.39%, right? Your yield on cost is actually going to be higher than 3.39 in this situation because Merck is not a $100 stock. It's an $87 stock. So which means that at a dividend of $3.39, it's going to be 339 over 87.56. That's a yield on cost of 389, guys. Okay, so that's basically how you want to look at it, because you're going to be getting back more and more of your initial investment in cash, right? You're not going to count your capital appreciation. You're still going to get that. So if you continue to forecast this out for the dividend, I believe, right? So I'm not going to go through everything, guys, because I think I explained it quite well in these first two examples here. If you do the same exact calculations out for 2023 and 2024, at the end of 2024, right, I believe Merck is now going to be paying out $3.91 per share, and they could increase it also, right? Now they probably would have just increased it. So they're going to be paying out $3.91 per share. And right now they're only paying out $2.76, which means that right now you might only get a dividend yield of 3.15, right? But by the end of December 2024, going to 2025, you're going to have a dividend yield of 4.5% of your cash back every single quarter or every single year, right? Now that might not seem like much, but remember, you're getting the money that the company is investing back into its business in terms of capital appreciation. And you've also been collecting dividends all these years as well. So you've got another 3.89%, 3.94%. Now you're getting 4.5% that could go up to 5, 6, 7, 8. You could be getting 10, 15% of your money back in 10 years, guys. So if you put in $10,000, you could be getting 1,500 back in cash only, right? Not including capital appreciation, which is pretty good. Like if you invest in, let's say you buy a basket of 10 different stocks like Merck, $100,000 worth of stock right now, you could be getting back 15,000 a year, right? 15,000 growing too. That could grow to 16,000, 17,000, 10 years, 20 years. 20 years, you could be getting back 25,000, 30,000 just in cash. So that's the way you guys want to look at this. And this is what I believe. I believe at the end of 2024, we're going to have a annual dividend payout of 391. Now, FastGraphs is a little more conservative, right? They believe it's going to be 325. But remember that the earnings are also a little more conservative for FastGraphs, and it's a older date, right? This is April 2022. I'm going based off of the newer Seeking Alpha data, which is pretty much live updated every day. So yeah, guys, I think that we have some good opportunities here. And now I'm going to calculate the total return with both the dividend and the capital appreciation. So for example, let's go out to January 2023. And let's say that Merck goes back to its normal 15 PE ratio valuation, right? So that you're going to get a $2.76 dividend, right? The dividend is probably going to get raised in December 2022, but you're not going to really get that raise by January 2023 in your total return, because the raise is only going to be going forward in 2023 and 2024, right? So you're going to have a share price of about 109, right? How do I get that 109? Well, I took these two scenarios right here in January 2023 that we calculated out. If you don't remember what those are, go back to this part in the video, right? And I basically took these two numbers and basically just went to the middle, 108, 110, I took 109, right? 109 share price. So if you take 109 plus the dividend, right, you're going to get minus $87 for the current price, divide by 87 times 100, that's 28.45% total return, right? You could get that total return within a year if Merck returns to its 15 price to earnings ratio. You might want to take away 1 or 2% for the missed dividend for the first half of 22, because we want to remember that $2.76 is assuming you got your dividend the whole year. So you're going to miss like a half of that, right? So you're probably going to get about a 27% return if Merck reverts back to its 15 price to earnings ratio, which is pretty good in my opinion for a year or even for 2 years, right? That's pretty good. Now let's extrapolate out to January 2025, right? Now you have 3 years of dividends that you're going to get now. This year's dividend, next year's dividend, the year after that dividend. You can't include the dividend I told you about in 391 because that's only going to be raised in December 2024. You're not going to get those dividends until 2025. So you add up these 3 dividends, right? And then you get the share price of 126 if it reverts back to 15 PE. And I really don't think I'm being too out of the league when I say, or too crazy when I say it's going to revert back to 15, because Merck has always traded around the 15, and every time it's gotten cheap, right? I mean, Merck was trading at a 15 PE, guys, when its growth was, okay, yeah, it's great growth before 2008, but 7, -5, 5, 10, 1, -9, 0, 3, 5, very low growth, and it's still trading around a 15 PE, right? But now that its Merck has been starting to grow 9, 20, 14, 11, 20, 0, 15, right? Sure, there's 1 year of 0, but if you add 20 and 15 and take the average of that, that's pretty good growth for over 3 years, right? It should at least be trading at a 15, maybe even a 16 or 17, right? So I don't really think I'm being too crazy when I say if it reverts back to 15. It's probably will, in my opinion, right? So if it reverts back to a 15 PE by the end of January 2025, you're going to have a $126 share price, right? Which basically means you take the total dividends plus the share price, right? Yep, I just did this a little differently, guys, but basically you're taking the change in the share price and you're adding the dividends to it, which is a total change of $49.58, dividing that by your total price right now, you get a 57% total return, and you're not including dividend reinvestment. For example, this is just saying you take the dividends and you spend it on something else, you go buy Subway with it. You could take those dividends and reinvest it back in the company, right? And then that would basically buy you more shares and more dividends and more dividends. So this could be 60% return, right? But basically, if you take a 57% return, that's basically a 19.5% annual rate of return to January 2025, guys. So 19.5% is very strong. And I do believe we're going to hit that. The reason why is I'll tell you, this is a great company in my opinion because of its consistency. It's because of where it's traded, because of the current valuation, right? Like I said, it's trading at a 13 PE, 13, 12, 13.5 PE when it usually trades at a 15. So with growing earnings the next 3 years. So I do think we have a good opportunity here to make some good returns. Okay. I also want to talk about the people don't touch this enough when they talk about companies, guys. You have to look back at past recessions, right? You have to look back at the dot-com blast, in 2001, 2002 dot-com crash, and see its earnings, didn't crater at all, actually, really, 2002. And during the Great Recession, earnings went down a little bit, right, to 19% in 2005, 2006, right? It actually seemed to have a bad year before the recession. So before the actual housing crisis and the banking crisis, credit crisis hit, seemed to have had its earnings debacle here. But this is the top line here is basically its earnings, and the bottom is its dividend. So even though its earnings did go down, a lot of companies went under, right, during 2008, and the company continued to have earnings that covered its dividend. The bottom line here is its dividend. Now, obviously, a few years it did not raise its dividend, right? It made a 285 earnings and it paid out 143 of that. Now it only made 230, so it didn't want to increase its dividend, obviously, but at least it kept it the same. 229, it kept it the same. And then when it started to rise again, the earnings started to rise, 291, 311, 295, 311. Finally, in 2011, 343, they're starting to raise their dividend again. 149, 161, 165, 169, 173, 176, 80, 90, 215, 236, 261. And like I said, I expect the dividends to continue raising. Here they believe 280, 298, 325. I believe it could be raised, honestly, 339, 343, 391. So I believe the dividend is going to be raised quite well. It's going to reward us, right? This is basically showing you the same thing, guys, right here, right? This is how the rate of growth of the dividend year over year, right? Like I said, 2011, it finally started growing again, 2.63%, 8%, 2. I want you guys to pay attention to this one thing here. It's really important. This is a good sign. When a company is starting to increase the rate of growth of its dividend, right? Usually companies, the bigger a company get, it slows down its rate of dividend growth. Well, this company is actually increasing its rate of dividend growth. It went from 2 the last few years, 10 years or so, to 13, 9, 10, right? Which means in 5, which basically means that they're probably going to expect higher earnings growth in the future, earnings growth, which is good because usually a company needs to grow earnings in order for it to increase its dividend, right? Because if a company is making the same earnings and it continues to increase its dividend, at some point it's going to be paying out all its earnings, and you don't want that, right? So now I analyze the balance sheet, guys. I go over balance sheet analysis to make sure Merck is strong enough to pay its debt, right? So Merck does have debt, guys. Now, a lot of people, when they think of debt, they think, oh, he's $1 billion in debt. He has $4 billion in debt, right? But a lot of times debt can be used to buy assets, right? You leverage debt because, for example, if you only have $100,000, you want to buy an apartment complex, right? You could leverage that debt to buy $1 million worth of apartment complexes, as long as that apartment complex is creating enough revenue and income in order for you to pay the bank the interest and pay all the utilities and all that, and you have extra cash left over. That's a good use of debt. So that's what we're going to see here. Merck has $31.79 billion versus total debt and $8.93 billion worth of cash. Now, I got all these values from Yahoo Finance and other sources, guys. I checked different sources, so you can go ahead and also check these numbers, right? But basically, this means cash and debt means it has 22.86 billion versus net debt. So yeah, obviously this is not right. You're going to look at this first and be like, holy crap, this is bad news. It's got more debt than it does cash. Well, let's look at the earnings. Like I said, if you own an apartment complex, you're not going to be overly worried about your debt if your tenants are bringing in cash every single month, right? Enough to pay the mortgage, pay whoever you need to, maintenance, whoever's watching over the apartment, lawns and stuff like that. So so first you have to look at EBITDA, which is earnings before interest, taxes, depreciation, amortization of the trailing 12 months, which is the last 12 months. EBITDA was $24 billion, guys. Now, usually a rule of thumb, and I'm going to skip to this third bullet point right here. Your total net debt to EBITDA ratio over 3 means you're getting into risky territory. I got this from Corporate Finance Institute website, which is a website that teaches, it's a very well-known website that teaches about corporate finance, how to analyze balance sheets. So basically a net debt to EBITDA ratio above 3 means, you're starting to go into the bad waters. Anything below 3 is usually a good sign, right? Less than 1 is great. And Merck's net debt to EBITDA is less than 1. Net debt over EBITDA, earnings before interest, taxes, depreciation, amortization, 24 billion, less than 1, which means the earnings are very strong enough to conquer this debt, right? Now, you also have to look at the interest coverage ratio, which is really the EBIT over interest expense on outstanding debt, yearly interest expense. Now, what is EBIT? EBIT is basically earnings before interest and taxes. So all you have to do here is pay your interest and then pay your taxes. Now, remember, interest payments are usually tax-free, right? Tax-free, which means that you don't have to worry about taxes until you pay your interest payments usually, right? So what that means is you have to look at it's earnings before interest and taxes, right? Over how much does it have to pay every year, like on its loans. That would be like equivalent to paying a mortgage, right? So if you're bringing in $1 billion in your real estate company, but you only have to pay $1 million out to the bank, shit, you're going to take as much debt as you can, right? Because that's great. So right here, Merck paid $806 billion of interest expenses in 2021, right? And their EBIT was 19.363 billion. This is billion, guys. Basically, their interest EBIT over 2021, which is their interest coverage ratio, was 24 times, right? That's actually a very good number because another well-cited source, Investopedia, an interest coverage ratio of 3 times is considered strong. So if you can pay your interest coverage 3 times over, that means that, okay, you've got it under control. So if you're making $300,000 in earnings before interest and taxes, like in, let's say, like in a real estate company, you got to pay out $100,000 to the bank. That's usually a good sign. It means you have your interest covered. 24 times is just incredible, which means that earnings have to really collapse, right? Even during, like, this is why I like to talk about recessions. Even during recessions, 2008 financial crisis, a little bit before 2008, its earnings only went down by 19%. So even if its earnings go down by 19%, it's not going to have an issue paying down its debt, right? So finally, these are all earnings. We get that, but earnings are just profits on paper, right? Your free cash flow is actually on the company's ledger, how much cash is actually going in and out. Because, for example, earnings are like, can be like receivables and stuff that a company is going to supposed to get from its vendors or whatever, people that are, or clients or whatever, but the client might not have actually paid the company yet. So free cash flow actually shows how much true cold hard cash is coming into the company. And in terms of Merck had in 2021 $8.67 billion worth of free cash flow just in 2021. So if you take the 8.67 billion, divide that by 806 billion, you get over 10 times. So it literally could have paid its interest payments 10 times over with its free cash flow. Free cash flow is all the money the company has left over to pay interest or dividends. So this is a very good sign, guys. It shows that the balance sheet is slightly levered, but in relation to its earnings, it's basically minuscule, right? Merck could honestly probably take out double the debt, buy more plants, more equipment, grow faster, but they're being kind of conservative, which I think is a good thing to do. I honestly probably would have taken on more debt when interest rates were at 0%, right? I think Merck did do that, but right now, obviously, interest rates are getting higher. But even at these interest rates right now, 1 or 2%, Merck could take on more debt. As an investor, I like their conservatism. So, right. So Merck is also given a credit rating of A+ by S&P Global. S&P Global is basically a credit rating provider. Right here, I have the table here. This is basically an upper medium grade credit rating, almost high grade. And I will show you guys that actually some sources say that S&P actually gave Merck an AA-, Wiki Ratings, which is actually a well-renowned, I know it's a wiki kind of like a Wikipedia, it sounds like, but Wiki Ratings is a good source for getting company ratings. They say that Merck is actually AA- by S&P, which is a good sign. That means it's high grade. And I agree because based off of what my calculations were here, Merck has seems like they have a good, they can pay their investors and they can pay their creditors or their bonds back easily. So I think that's a good sign, guys. What other companies are also A plus rated? Well, we have Bank of America, Coca-Cola, PepsiCo, JP Morgan Chase, United Health Group. Oracle's only an A, right? And Wiki Rating, like I said, says Merck is double A minus. This is the same as Cisco, Amazon, Nike. These are blue chip of the blue chip companies. So, I really do believe that Merck has good potential, guys, for the next few years, maybe even for the next 10 years. And like I said, whether you agree with Merck or Big Pharma or you don't, that's okay to have your personal opinion. But as an investor, you have to realize that um, your investments, in a way, almost have to be you have to get your political party affiliation or other affiliations out of your investments, because at the end of the day, the company does not care about your money doesn't care, right? Money is going to make money depending on how it performs and how the free market assigns value to it, to an investment. And basically, obviously, the free market has assigned a good value to Merck by giving it. People are buying their products, right? Doctors, patients, they're buying their products. So I believe that's going to continue, right? Especially as healthcare becomes more and more important in this country, guys. I always tell you, right? I tell you guys not to be reliant on drugs or even pharmaceutical drugs, any drugs really, to keep yourself afloat, right, or alive. But obviously, there's people, unfortunately, that do have health issues, and this basically gives us uh, it's not like Merck is being a villain, right? Merck is actually providing solutions to people that have, cancers or immune system issues or other things that they want to deal with, right? For example, AbbVie is a big biotech company that also gives Botox. A lot of people are into Botox and stuff, but they always think the pharmaceutical companies are bad. Well, where are you going to go buy your Botox? You're literally giving somebody money to go and get those injections. So, guys, yeah, I think you have to look at this from a rational point of view, right? And I want to end my presentation with saying thank you for watching. I hope you enjoyed it. I hope you got some value out of it. And like I said, guys, next week or the next 1 or 2 weeks, I hope to do another video. I'm trying to get my friend on who works in the finance industry. I want him to come on and talk to you guys about how he sees the markets, the financial conditions and equities in the market today. And he'll give you a different perspective because he lives in a different part of the country than I do. He lives in the Northeast and I live in the Midwest. So yeah, guys, thank you very much. Take care of your health, take care of your life, have a good life, work hard, and I'll see you guys later. Have a good evening.